Welcome to today's Explainer, where we're going to decode the top-performing, yet historically boring, investment framework of 2026. Look, let's just be honest for a second. Investing over the last couple of years, it's been utterly exhausting. We are constantly bombarded by the sheer noise of the market. Between the relentless AI hype cycles, the daily speculations, and those massive stomach-churning swings in crypto, there's a really profound sense of fatigue setting in among investors. Everyone is desperately trying to pick the next massive winner while simultaneously absolutely terrified of losing their shirt. But what if I told you the true winners right now aren't playing that chaotic game at all? Today, we're looking under the hood of a structural renaissance in multi-asset volatility targeting that is just quietly dominating the market. We're breaking down the Sleep Like a Baby 25-25-25-25 audit.
Okay, so let's dive into this by asking a question that completely shatters expectations. In an era defined by artificial intelligence buildouts and digital currencies, what is actually winning? Honestly, you'd be completely forgiven for assuming the answer is a 100% equity allocation heavily concentrated in those magnificent 7 tech stocks. After all, that is exactly what drives the daily headlines. It's that intense fear of missing out, or FOMO, that pushes so many retail investors to over-concentrate their wealth into one single sector, assuming that if they aren't fully exposed to tech, they're just losing the game.
But prepare to be surprised here. A recent Bank of America report reveals that a highly defensive asset allocation is currently crushing the broader market with a staggering 26% annualized gain. And I really want to emphasize the paradox of this because it's wild. This is an extraordinary figure for a strategy that was fundamentally designed primarily for defense, capital preservation, and volatility mitigation. It wasn't built for aggressive growth. Think about what that actually means in real dollars. While everyone else is biting their nails, checking their brokerage apps 10 times a day, and absorbing massive daily swings, a basic $100,000 portfolio using this quote-unquote boring defensive strategy just quietly added $26,000 in value.
So, the absolutely crucial point here is that there's a massive gap right now between what everyday retail investors are doing and what the smart money is doing. While regular investors are chasing highly concentrated tech or crypto positions, they are unknowingly exposing themselves to terrifying sequence of returns risk. Just imagine someone who recently retired. If their 100% tech portfolio drops 40% in year 1, it almost doesn't matter what the market does in year 10. The math is fundamentally broken and their capital is permanently impaired. Institutional capital, on the other hand, they're currently harvesting massive alpha from a brilliantly boring strategy engineered all the way back in 1933. It is literally on track for its best annual performance in over 90 years, crushing the S&P 500 while carrying roughly half the annualized volatility.
So let's map out our technical audit to see exactly how this engine operates. We're going to cover the 25-25-25-25 breakdown, look at the ultimate stagflation hedge, dive into engineering the rebalancing bonus, tackle the crucial psychology of drawdowns, and finally walk through implementing the 2026 pivot for yourself.
Section 1. The 25-25-25-25 breakdown. Let's start right at the fundamental architecture of the portfolio itself.
The elegance of this strategy really lies in its absolute simplicity. We're looking at 4 equal slices: 25% stocks, 25% bonds, 25% cash, and 25% commodities. Originally derived from Harry Browne's classic permanent portfolio, this specific setup acknowledges a deeply humbling truth that almost no Wall Street analyst wants to admit out loud. And that truth is, human beings, no matter how highly paid or educated, are terrible at predicting the macroeconomic weather. We simply cannot predict with certainty which economic environment will dominate next year. Is it going to be wild prosperity, rampant inflation, a crushing recession, severe deflation? Because we can't predict the weather, we build a vehicle equipped with 4 independent shock absorbers, expertly designed to drive smoothly through absolutely all of it.
Now, notice how the resource nationalism and inflation we're experiencing in 2026 map directly to historical crisis periods where this exact model dramatically outperformed traditional 60-40 splits. There are some really fascinating parallels here to 1933's monetary reconfiguration during the exit from the Great Depression, 1946's massive post-World War II inflation spike, and of course 1973's infamous stagflation oil crisis. Why does this matter for us today? Because in environments marked by supply-side shocks and shifting global trade, the traditional 60% stock and 40% bond portfolio fails completely. See, normally, when stocks drop, bonds go up to protect you. But in 1973, and we are seeing strong echoes of this today, inflation causes both stocks and bonds to lose value simultaneously. In those specific toxic environments, this 4-pillar model historically shines.
Section 2. The ultimate stagflation hedge. Let's see how this structure builds into a powerful defense against stagflation, which is pretty much the absolute death knell for standard investing models.
Just examine the massive internal dispersion of returns we've seen throughout 2026. Think of each slice as having a very specific independent job. By holding a fixed 25% weight in commodities, which surge anywhere between 24 and 33%, the portfolio utilizes a massive inflation sponge. It instantly prices in the rising cost of goods by relying on the intrinsic physical utility of energy and industrial metals. Meanwhile, look at that 25% cash buffer. It's no longer a drag on your portfolio. Sitting on a risk-free 3.75% to 4.2% yield, that cash acts as your liquid dry powder. It's essentially an option to buy future volatility whenever things get cheap. Your equity slice captures the wild jumps in sectors like semiconductors, acting as your aggressive growth engine. And finally, the bonds. Languishing near 0% returns, they aren't there to make you rich right now. They are simply serving as your deflationary ballast, just waiting for a recessionary shock.
Section 3. Engineering the rebalancing bonus. Let's enter the mechanical core of the strategy to understand the exact math behind how this generates those outsized returns. To really grasp the secret sauce here, we have to understand something called volatility drag. This is the mathematical reduction of your geometric returns caused by wide portfolio variance. Let's make this highly concrete, all right? If you start with $100,000 and your portfolio drops 50%, you are now sitting at $50,000. The brutal truth is that a 50% gain the following year does not get your money back. A 50% gain only brings you up to $75,000. You actually need a massive 100% gain just to survive and break even. True multi-asset volatility targeting minimizes this variance by blending completely uncorrelated assets. When you mix gold and oil with stocks and bonds, you shrink your total portfolio variance. This completely changes how compounding works in your favor, because you're no longer spending a decade digging yourself out of steep mathematical holes.
And this brings us to a really fascinating concept known as Shannon's demon. This is an investment theory demonstrating that systematically rebalancing between a highly volatile asset and a highly stable one actually generates positive returns basically out of thin air. Picture a playground seesaw. On one side, you have the wild volatility of the semiconductor index or crude oil bouncing wildly up and down. On the other side, you have cash. Volatility isn't something to fear here. It is literally the fuel that this strategy's rebalancing engine uses to capture gains. Every single time the volatile side spikes, you sell the rip and move the profit to the stable side. Every time the volatile side crashes, you use the stable cash to buy the dip. Even if the volatile asset ends up perfectly flat over 5 years, the sheer act of rebalancing creates mathematical alpha.
When we analyze the specific rebalancing mechanisms, we see that executing this strategy requires rigorous mechanics. If you never rebalance, well, you eventually end up with a portfolio that's 80% equities, and you face extreme risk in a sudden trend reversal. If you choose to only rebalance annually, which is, the traditional advice, you suffer from significant portfolio drift because a fast-moving market in 2026 will completely run away from you over 12 months. The sweet spot, giving you real-world efficiency, has proven to be either a rigid quarterly reset or a 10% drift band rule. That means you only rebalance when an asset hits 15% or 35% of your total. This effectively captures the bulk of the volatility harvest without getting eaten alive by transaction costs.
Now, for those who are still working and in the wealth accumulation phase, utilizing top-up rebalancing is an absolute game changer. It is the ultimate tax-efficient piston in our engine. Let's say you get your monthly paycheck. Instead of selling off your surging commodities or chip stocks to rebalance, which, of course, triggers a painful capital gains tax hit, you simply look at which asset has fallen below 25%. You then direct all your fresh monthly savings exclusively into those lagging assets. Dodging the capital gains tax acts as an invisible yield booster. You mathematically restore your equal balance by buying the cheapest assets available without triggering a single tax event on your massive winners.
Section 4. The psychology of drawdowns. Of course, the most brilliant mathematical model in the world completely fails if the human operating it begins to panic.
This brings us to a very real concept called the star and the dog. Because this portfolio holds 4 uncorrelated assets, it will by design always contain a thriving star and a miserable underperforming dog. And this creates an incredibly uncomfortable internal tension. You are actively forcing yourself to sell high and buy low against every single biological impulse in your body. In 2026, commodities were your glittering star and long-term bonds were your absolute dog. Human instinct screams at us to chase momentum, right? To buy more of whatever just went up and dump the loser. It literally feels painful to sell high-flying tech stocks to buy boring dropping treasuries, but that psychological discomfort, That is the exact, necessary price of admission for long-term compounding.
The data from March 2026 proves the sleep like a baby factor in a highly practical way. Think back to the intense volatility event triggered by geopolitical conflict that spring. The tech-heavy S&P 500 suffered an 11% maximum drawdown in a matter of days, erasing trillions in market cap. Just think about the physical reality of opening your brokerage app and seeing 11% of your life savings wiped out. Retail investors absolutely panicked. But in that exact same period, the 25-25-25-25 portfolio actually saw its energy holdings aggressively spike in value, acting as a massive counterweight. The result? A microscopic 3.2% maximum drawdown. Experiencing a mild 3.2% paper loss instead of an 11% free fall fundamentally changes your emotional reality.
Behavioral scientists heavily study loss aversion. This is the proven fact that human beings feel the emotional pain of a financial loss about twice as intensely as the joy of an equivalent gain. As our sources heavily emphasize, the most significant impediment to long-term wealth is not the market's performance, but the investor's behavior. This strategy wins precisely because it isn't trying to maximize the absolute top of a bull market. Rather, it focuses intensely on raising the floor so high during a crash that you never ever feel compelled to panic sell at the absolute bottom. By smoothing out the erratic ride, it keeps you calmly seated at the table long enough for true generational compounding to actually happen.
Section 5. Implementing the 2026 Pivot. So, how do we actually put this all into practice today?
Here's the exact architecture to implement this framework today using widely accessible, low-cost tools. By deliberately distributing your capital across these 4 specific pillars, you build a fortress against uncertainty. First, you utilize a 25% equal weight S&P 500 ETF. Why equal weight instead of market cap weighted? Because it prevents you from being overly exposed to the concentration risk of just a few massive tech giants at the top of the index. Second, you added 25% resource and commodity ETF to capture the inflation hedging power of energy and industrial metals. Third, you park 25% directly in money markets or short-term T-bills to lock in that high, incredibly safe cash yield. And finally, you place the last 25% in the total bond market or long-term treasuries to act as your ultimate deflationary protection. It's highly accessible, it's mathematically simple, and historically, it is incredibly robust.
That wraps up our explainer on the permanent portfolio. I want to leave you with one final thought to really reflect on today. Are you still intentionally chasing the profound anxiety of last year's blowout trades? Or are you finally ready to harvest volatility, step off the roller coaster, and sleep like a baby? Because surviving the drawdown without panicking, that is the ultimate secret to winning the game. The math is completely on your side, just as long as you can manage the psychology. Thanks so much for joining me on this deep dive, and keep learning out there.